At kdkr.org. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, today, looking at banking just a little bit differently. Today, we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, today I'm not taking questions, and I will take questions through the website at www.prudentmoney.com. Ask Bob is where you go, and you just send a question in, and I will get that taken care of for you. That's all at the website, www.prudentmoney.com. Every once in a while, I like to take a break from talking about markets and, of course, the banking system and everything we've been talking about here as of lately, and just go over some questions that I have come in. I've always got a theory about that, is that for every question that comes in, there's a real good percentage of the listening audience that probably has the same question or would be interested in knowing what the answer is. So I like to collect these questions and answer them and talk about what you should consider. The first one has to do with the banking system and the higher interest rate savings accounts or money markets. It says, Dear Bob, I've heard many different forms of advice about higher interest savings account. Can you tell me the most important things to look for? You know, I did a lot of thinking about this because I get this question a lot. It's kind of one of those things where people were so accustomed to getting nothing on savings accounts or money market accounts. I mean, it was like 0.01. The irony is that banks are, for the most part, the high percentage of them, their savings accounts are still at 0.01. But it's looking beyond the bank that you start to find much higher interest rates that are being paid out on savings money market accounts. So what ends up happening is people are just starting to realize, hey, what is my money getting paid in savings account or interest-bearing accounts at the bank? And they're starting to take some action. In fact, this is one of the things that the regulators are concerned about, is the amount of money that will flow out of big banks because they're just not paying anything. So the first thing that you want to figure out is the range, and I'll tell you why in a little bit why this is important. Figure out the range of interest rates that are being paid on interest-bearing accounts, because there is quite a range. I would probably look at it in the 3.5% to 4.5% range. The second thing that you want to look at, and I'll tell you why in just a minute, don't take the highest interest rate that's out there right now, because I have a theory that if the going rate is somewhere between 3.5% and 4.5%, and yet a bank or an online bank or somebody is paying a little over 5% just to get money to come into their bank, to me they're taking a risk that I don't think makes sense. Because if they weren't taking a risk, then you would have a lot of other online banks being very competitive with them at a 5% interest rate. So don't take the highest rate. I don't always think that's the best way to go. Besides, the online terms could be, after you read through them, and you definitely want to read through the terms and the conditions on anything before you put your money into it, to make sure that there's no surprises. Number 3, there is, of course, the online banking presence versus online banking and brick and mortar banks. I personally like to be able to walk into my bank, and you can call me old-fashioned, but I like to walk into the bank. I like to see the bank. I like to see that there's a teller at the bank, and that's how I like to do banking. And I do some banking online, but you got to consider the pros and cons of online banking. And versus brick and mortar. I mean, with your brick and mortar, you've got higher expenses for the bank, so they transfer those to you through interest rates that aren't as high as other places that you can get. So you want to be real careful about that when you're choosing a brick and mortar bank or one of the big banks or anything like that. The online presence it's probably a bank you've never heard of. Probably is probably 100% of a bank that you've never heard of. And of course there's other banks that you've heard of, but they're all online. You just want to weigh the pros and cons of whether or not you feel comfortable with that. Convenience and comfort level once again of who you're banking with, if you feel comfortable with them versus I don't know about this. I've never heard of this bank before. We kind of covered that. And the convenience of doing banking with them, how you like to bank, and if it's convenient or not. Remember that number 5, small banks are more the problem. And this is regardless of FDIC or anything like that. You don't want to get caught in a situation where you're with a small bank and something happens with that small bank. Remember, there were, and of course they didn't publish the list for good reason, but a recent study showed that 186 banks are in the same shape as Silicon Valley Bank. And the Silicon Valley Bank was the biggest bank in history to go under and get taken over by regulators. So keep that in mind when you're thinking about the fact that it is a small bank that you're probably going to on an online basis. Number 6, you got to know the difference between money markets versus savings accounts. Now banks, and this is where it gets really confusing, and you got to ask a lot of questions. Typically you see money markets at investment companies, and you see savings accounts at banks. Savings accounts are not paying much. Money markets are really kind of the same thing as savings accounts. They're both invested into very liquid, high short-term type debt instruments that are designed and supposed to not go below the dollar per share limit, which is what they're priced at. So in other words, you're not supposed to be in a situation where you're going to lose money. Having said that, and going back to the situation with the financial crisis, there was one money market that did lose money, and was starting to lose money, and the regulators stepped right in and backstopped that, because you think a run on the bank is bad. Savings accounts and money markets if they start to lose money, that could be just about as bad as a bank going under. So make sure that you understand that a money market is probably not as insured by FDIC, and it gets even a little bit more confusing if a money market is with a bank that also has investment services. So you want to make sure that you understand money markets and whether or not they are FDIC insured, which you're probably not, or SIPC insured, which is a form of insurance for the investment and broker-dealer world that covers cash accounts or money market accounts in their investment firm up to $250,000 max per depositor. And that coverage is there in case the investment company goes insolvent or has a problem and files for bankruptcy. It's a protection vehicle. FDIC, though, is probably still the strongest and the better protection. So these are some of the things that you want to consider and take into as you think through the process, whether you want to be, money markets, for instance, most of your big money markets are backed by U.S. government securities, which brings in another somewhat, I don't want to say protection, because protection is probably not a good word, that takes a little bit to the next level, but some peace of mind, because government securities are backed by the full faith and trust of the U.S. government, whatever that means. So just do your homework, make sure you're comfortable with who you bank with, and that going with the highest rate is not always. And then here's the other thing too: the difference between 3.5% and 4%. Obviously, 0.5% is just not that great of a difference. To maybe sacrifice or take on a little bit of risk that you don't know is there, and you won't know it until it's maybe too late. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I had a question come in. Dear Bob, will you go back over the 5 steps of building a good retirement plan? We talked a little bit about this yesterday, but I kind of rushed through it, so it would make sense to go back and mention it one more time. You see, this is the problem, the big difference between the way that I go about retirement planning versus the rules-based way pop culture finance goes about retirement planning. And whereas you'll read articles where that it says, if you save 15 or 20% a year for the rest of your life, you'll have a great retirement, and they leave out all the variables that could affect whether or not you'll have enough money invested and saved back to actually retire like you want to. So it leaves it makes it sound like, well, if I just follow this one rule, I'll be good. Maybe, probably not, but maybe. So it comes down to a rules-based process, which we talked about yesterday, versus a customized process, which is the 5 steps. But we will go over that after the break. This is Bob Brooks. Stick around. I'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, pastorchuck.org. At pastorchuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at pastorchuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, pastorchuck.org.
In 1 Corinthians, Paul reminds us to run the race of life to win the prize. Join me, Dr. Erwin Lutzer, for Running to Win. Be strengthened to finish your race with confidence.
Weekday mornings at 8 o'clock here on KDKR.
This week on Truth for Life, Alistair Begg concludes Esther's dramatic story and begins a series titled Some Strange Ideas. We'll look at the events of Palm Sunday from a surprising perspective and consider Jesus' odd requests at the Last Supper. That's our focus on Truth for Life with Alistair Begg.
Weekdays at 5:30 a.m. here on 91.3 KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Today I'm not taking calls, and if you got a question for me, please go to the website, www.prudentmoney.com. Send it in, and I will get that answered for you. We're talking about questions that have come in and talking about the answers to some of these questions. I was about to jump into the 5 steps of building a good retirement plan. The first one, of course, is planning. You wouldn't start building a house without a blueprint, nor should you start considering how you're going to build your retirement plan without an actual plan. As I've always said, this doesn't have to be a very detailed type plan. You just need to know the important numbers that make up the plan, that create the targets, create the growth that you need on an annual basis, create the risk that you're going to be taking that you're comfortable with, and it makes everything make sense. So you want that plan. The second is you got to be willing to save money, and you need to figure out how much you can save. And then you've got to select an investing strategy, which there's many to choose from. Probably the main one is to go with a buy and hold type strategy, to where you just let the money invest and stay invested for the long term. Pros and cons to that. Another one is to have an actual strategy to manage for risk and for growth, but you definitely want to have a strategy versus just investing. Then probably the most important and the one that's left out the most out of any process is the management of the account, which is something either you can do or you can pay somebody to do, but basically managing for risk and managing for times when the stock market goes into downturns, which I would suggest we are in that environment today. And then most importantly, and probably the most gratifying, is the tracking of your plan. Now, wouldn't it be great if you knew your numbers, you've calculated out your numbers, you've made good assumptions, and you have some financial decisions to make, and you want to know if you're on track for your retirement plan based on what you're doing today. And you know what that retirement plan looks like and everything. All you've got to do is literally go to a page and look up two numbers. And through those two numbers, it will tell you if you're on track or not. Now, wouldn't it be even better if you could adjust that retirement plan a little bit to allow you to do something else financially that you need to do? That's the beauty of a retirement plan, because you can be flexible with it. You can change numbers. You can change plans. You can to create extra money for things that have to be taken care of today. For most people, they're kind of going in the dark as far as, should I spend money? Should I get this repair done? Should we remodel the kitchen right now, or should we wait, or whatever the question might be, and take it from there. Dear Bob, how do you go about picking a bank? Well, let's start with how, in general, people feel about banks, and this was from depositaccounts.com. The survey on banks stated that large national banks are the most popular among Americans, as almost a third, 31% of consumers primarily bank with one, but while convenient, they may not be the best place to grow your money. They are an awful place to grow your money because they don't pay any interest. But people tend to gravitate towards the large banks, and there's kind of some pros and cons with that, which we've talked about as far as looking for your larger interest rate paying accounts. Number two, it might be more comfortable, but for some consumers to do their banking in person, but the best high yield savings accounts are generally found online, which we talked about that. Getting a return on your bank account is a real thing, but I would suggest that that is probably really last on your list, and really for most people not even something that makes that much sense, because you should maintain the smaller amount of money that you're going to be using for bills in your banking checking account, where it's not as big as maybe your savings account or your money market account that has your emergency fund money. This one will, not surprising, but is a little bit disturbing. 63% of people don't know their current interest rates. This means 74% of Americans aren't primarily banking where the lowest checking rate accounts generally are found, leaving money on the table. Once again, I don't think that you're going to find a bank that's going to pay a high enough interest rate on checking and then turn around and provide you with a money market that's paying the same. What's going to be a give and take? So I wouldn't focus as much on the checking account. So the question comes in, why are the rates of interest so low at banks? Why don't people move? Well, I think that the interest rates are so low on savings accounts and that kind of thing is that they have to provide FDIC insurance, which is a benefit at a bank that you can't, and there's a cost to that. It's not a displayed cost, but there is a cost for that I think comes down to affect the interest rate that are given on savings accounts. The second thing is, well, why don't people move? And I love this explanation from depositaccounts.com. It says many consumers focus mostly on checking accounts at their banks, and large national banks can be convenient to use for checking accounts. Listen to this though. Once a consumer has an established checking account, the inertia typically prevents them from changing. And I see this all the time. People will have interest in changing to get the better interest rate, to be able to have more benefits with money market accounts and that kind of thing. But they don't want to change everything from where they bank to a new bank. They don't want to move. And then a lot of this, I believe, is with your big banks. Just keep in mind that if you move from a big bank, you're probably going to go to a medium-sized or to a smaller-sized bank, which is nothing wrong with that, except those are the sizes of the banks that are under the microscope right now. So you just want to be aware of that. But I do see people get settled in and they talk about it, but the thought of moving a bank account and history and everything, the systems, processes, it's just not something people want to do. But I would look for a well-known brand, and that could be a medium-sized banking chain, but just a bank that has a well-known brand, not some bank that's online that nobody's ever heard of. Big banks are probably the safest, but it's all relative. Anything can happen, so you don't want to get comfortable with the idea, oh, I'm at a big bank and everything is great and no problems, and that's all, everything's taken care of. Even a big bank can run into problems. We saw that in 2008. Medium-sized banks, which I bank at a regional medium-sized bank, which I'm very comfortable with, and those can be something that you could look for. And then think about this. This is a different way to go about it, but think of your banking relationship as two different parts. One is the checking aspect, which you could easily use a big bank for, and one is for a savings account or money market account, which is drawing a much higher interest rates for your emergency fund money, or maybe the bulk of money that you would normally keep in a checking account, but you're going to keep less in a checking account. And then what you do is, once you get those two set up online, in most cases, you can transfer money from the bigger amount that's in the savings or money market account from another institution into your banking account. So you can think of it that way. And actually, to me, that's really the best way to go. You're keeping your checking account at your bank that you've been with forever, but you're moving your account maybe to a Fidelity and taking advantage of the money markets that they have, or a Vanguard or a Charles Schwab, and transferring money to your checking account when you need it. So that's just, I think you got to think different. You got to think out of the box when it does come to banking. And I was considering this as I was prepping for this question, is that things have definitely changed, and maybe the answer is to not one-stop shopping. Of course, banks would love for you to do one-stop shopping. They make the most money. maybe that's not the best rule of thumb. Maybe it is that you bank checking accounts with the big banks, and then you have another institution that holds just a cash account, a money market, something like that, and you can transfer. I mean, with electronic banking the way it is today, it's just so easy to move money from one institution to another institution. Especially the big banks have great technology, and your big brokerage houses do as well. So maybe something to consider as you are thinking about establishing new relationships and new places to do business. Hey, this is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.